So now the last time you were here, you raised the red flag and said, look, there's some bad things coming. We've got some real downturns in the economy. How does this gold price, this oil price, the commodity prices, how does that weigh in your thinking as to what's going on?
Typically, when you see gold rising, in particular, it's a sign of uncertainty. Gold tends to be a hedge when people are not really feeling great about not just the economy, but also the geopolitical conflict. Gold historically has been a safe haven. And so as long as people think gold has value and goes up, as long as people think gold has value, then it does. And so far, that's what it looks like right now.
And what do you think? I mean, what does it indicate? Does it indicate fear? People getting out of the market? People going into safe havens like cash or bonds? What are you thinking?
Yeah, I think so, Steve. I take an approach where I call it actively hedging and harvesting, right? So I want to make sure that my downside is protected. At this point, it's not just the economic. I mean, we were heading towards an economic downturn anyway, and that's before the tensions broke out in the Middle East. And so all that does is make oil prices go up because it potentially could restrict supply, and we're going to get into these different, financial wars in addition to potentially the kinetic side. Gold is probably going to keep going up just because it's viewed as a defensive asset. And, with all due respect to Janet Yellen, who said we can certainly afford to fight two wars financially, I mean, the reality is we have 120% of debt to GDP. And what we're seeing, in my opinion, is the return of the bond vigilante. You look at the 10-year Treasury, it's back up to 4.85% right now. And so that's the fact that the long-term yields on government bonds are going up is saying that people are dumping those securities. That's not a great sign.
Where are we, do you think? I mean, we look at all these tea leaves. I do. Everybody does. And, wants to know where they're going to be when it's time to retire, or maybe they are retired and they're like, is my nest egg going to hold, or is it going to get smashed and turned into an omelet? Honestly. And so you put all these things out there, Terry, and from a practical, real-world level, what do you think?
I think, I think the biggest difference, Steve, between pros that run money and then the average person that's just trying to get by is that the pros know how to hedge, right? And they can use options and derivatives and all kinds of different strategies where they can participate if the market keeps going up. But if it doesn't, they don't get hurt badly. The typical smaller investor, and I say smaller, this could be someone that's worth $10 million or less. So it's not small, but it's just small relative to the institutions. They don't have that level of sophistication or access to the resources, et cetera. So there are times where it just makes sense to take your ball and go home. Steve, this is it. We're on the front door. The smart play here is to put most of the money, and I'm just talking generally, I'm not giving specific advice here, but I'm just saying, I think we're at a point where short-term government bonds are paying over 5%. So somebody can get paid 5% to sit and wait and look at how this plays out. And I'm reasonably confident. Anyone who's exceptionally confident is probably full of you-know-what, okay? I am reasonably confident that we're heading towards a significant downturn. And if you are retirement minded and you don't want to jeopardize your future security, then this is a time where you just batten down the hatches, get your 5%, sit and wait for a better opportunity.